Great. So hello everyone. This is Richard Peterson with MarketPsych Data, presenting today on developing trading models using machine learning on financial news and social media data. So we've been involved in this area for more than 20 years, as you'll see from our trading examples. And it's a notoriously difficult problem to solve, both the sentiment data aspect for the media and also developing trading models that survive, that work consistently over time. So I'll talk a bit about both the machine learning modeling and the challenges and then the sentiment data itself. But first of all, some disclaimers. So as we're showing you strategies, please don't, please understand that these are past returns, not necessarily going to be continuing into the future. And we are showing you live trading results, actual trading track records. So again, this is the real thing, but still, it's not necessarily going to continue. And another page of disclaimers here. All right, so our agenda today again is diving into the media sentiment data, which is interestingly really optimal for machine learning strategies. Media sentiment data is nonlinear. There are bursts of articles. There are bursts of tones and fear, for example, or there are bursts of certain subjects or themes that appear in the media. And if we can test these over many assets over decades, we can then start to discern patterns in these. Piecing that together into a coherent trading strategy, though, is not a linear proposition. It requires nonlinear techniques like in machine learning. So in the machine learning section, I'll talk to you a bit about some background of machine learning and algorithms used there, as well as current packages and some other approaches. Then we'll talk about our trading track records, our three endeavors using machine learning, first in 1995, then again in 2008, and then again most recently last year. And we'll show you the live trading track records for the most recent attempts. So media sentiment data, what I'll be jumping into today, we'll be talking about the Thomson Reuters MarketPsych indices. It's a fairly complex product, and the best way to think about this is in terms of the difference between structured data. So structured data is data like earnings reports or prices, data that occurs periodically and systematically, time after time. Then there's other types of data that occur in bursts or sort of, like Google Trends analysis or satellite data of parking lots, data that's sampled maybe not periodically or that shows results that are not consistent over time. Structured data, this example here is the non-farm payrolls release. Structured data is very easy for quants to analyze in the sense that we know generally what it means. So in this example here, the dollar index futures jumped very quickly after the release of the non-farm payrolls result. So in this Thomson Reuters data set, Newsfeed Direct Service published the timestamp for the non-farm payrolls, and then suddenly within 100 milliseconds, the price had readjusted and the opportunity was finished. Shown the next slide here, that was structured information, non-farm payrolls like earnings. Now there's unstructured information as well, which is what we'll be talking about today, like in media sentiment data. Information that's transmitted in text is often nuanced. We can classify it as positive or negative in terms of the author's tone or in terms of the market impact, but ultimately it helps to know the more nuanced aspects of that information, like emotional tone, uncertainty in the conveyed information, or complex meanings like predictions about the future, like optimism in the future tense, or predictions of earnings, for example. These can all be quantified in text, and that's what we actually do, and what we'll be showing you today is how to combine all of this with machine learning. Now, social and news media both have different market impact and different characteristics. So we'll analyze those. Those can be analyzed separately. And then once derived, such media sentiment data is, again, nonlinear in character, very similar to the VIX index itself. So we produce and use the TRMI, the Thomson Reuters MarketPsych indices. So we are obviously biased towards these indices because it's what we've been producing and using for over a decade. It has very extensive coverage from 1998 to the present for both news and social media sources. It covers 130 countries, 10,000 companies, more than 50 stock indexes, 30 currencies, and 35 commodities. And then it also comes in minutely, hourly, and daily time windows. So it's highly dimensional, low latency, and fairly interesting on many levels. It also comes with separate news and social media feeds because, as I had mentioned, news and social media tend to have different content baskets, and if you use them separately, they can be quite interesting on their own. So our text sources for the news are 2,000 primary global news sources, the top Alexa ranked sources, and then for social media we use 800 blogs, message boards, and social media sites. Then we derive some key types of sentiment indicators, like emotional indicators, also some indicators around fundamental perceptions, like earnings expectations, and then some buzz metrics, such as how much something is discussed, like litigation or mergers, for example. Then by analyzing this through automated text analysis, we are able to create quantitative scores. So we create time series for how all of these different factors really are presented over time about different tradable assets. So what you see here are, for example, topics and tones like analyst rating. We have an index for analyst rating, an index for consumer sentiment, and a whole host of different indexes that we can actually pull out of the text and quantify. And then again, these create a time series. So you can see here a rolling average time series since 1998 of the overall media sentiment about the S&P 500 constituents, rolled together into this moving average to smooth it, because this data is quite noisy, and then able to see, over time how this appears. Below that what we see is a, for example, cross-sectional rotation model, an equity curve based on the arbitrage of the earnings forecasts of different companies in the media. So on a given day, for example, we would buy the companies with the highest earnings forecast and short the tier with the lowest earnings forecast and arbitrage the difference. And what we see in this kind of cross-sectional rotation model is that there does appear to be information at the absolute levels. So the first example here of a moving average crossover shows that sentiment itself does appear to have some predictability when sentiment declines, short-term sentiment versus long-term. We do tend to see turning points in the markets as well, at least over this time frame. Then in other cases, we see that absolute levels of sentiment seem to have some predictability as well. And the sentiment data itself, when we distill it into indexes, does not necessarily look linear. For example, this is our index earnings surprise. So for the most part, people aren't really talking about an earnings surprise, but some days they're talking about it a lot. So those days would be the days that it actually happens. Other, for example, indexes like fear also tend not to have a very high, this is the mean is down low, but the maximum is quite high. So some days we have sheer panic, but most of the time we're sort of in a low level of fear with fairly rigid bounds. And same in this case, optimism is quite different. Optimism is optimism versus pessimism, and sometimes we have extreme pessimism, but most of the time we're sort of in a middle band here without a lot of action. So that's what's also called the nonlinearity of this data. And you can see this purple line here is a fundamental strength moving average. Obviously during earnings season, there's a lot more discussion about fundamentals. And this blue line is the stock index itself. And there's another example here, which is the Turkish lira versus the US dollar. The value is in the black line here. The buzz about the Turkish lira in the media, so the total amount of chatter, is here with the y-axis on the right side. And we can see it here in the blue line. So this is back in around the Gezi Park protests in Turkey in 2013 to 2014. So we see a big spike in buzz about the Turkish lira right around the time of the bottom. And again, this is an illustration of how nonlinear this data is, how there's a lot of spikes. And some of the interesting information is in the turning points, both the absolute levels and then the changes from the absolute, maybe back to the mean. So again, we find that different statistical models are quite useful. Looking at absolute levels and relative rankings between absolute levels is quite useful. In fact, one of our data clients was just in the media a few weeks ago saying that they had used relative rankings between sector sentiment to do quite well in terms of, I believe, shorting utilities and buying financials towards the end of last year. So arbitraging the sentiment can be quite useful based on the relative rankings of sentiment across assets. We can also use z-scores to transform this data into z-scores, which are really the deltas or the change from day to day or minute to minute, telling us when there's a burst of information. And then, of course, I'd mentioned moving average crossovers, which are smoothed ways of looking at transitions, really state changes in the market, whether it's over a short-term period or a long-term period. It allows us to see when the tone in the media is shifting, and presumably, and there's some significant evidence for this, people tend to delay their responses, and it gives an opportunity to get in. In fact, again, on this number 3, we have a data client who's been in the media several times reporting on how very similar moving averages help them to avoid market corrections. So again, these in a discretionary use can be quite useful, and most of our quant clients don't talk about exactly what they're doing, but I will talk about what we've done in our own trading, which should be useful. So machine learning is obviously a very deep and complex subject. I'm not an expert in machine learning, except insofar as I've used quite a bit of different algorithms in different ways. So I have the practical experience, but I don't have the theoretical background anymore. I did take some classes years ago, but things have evolved since then. So where are we now in AI, and why the enthusiasm now? Well, largely because there's been this progression. Now, when I started in machine learning was in 1994. Back then we used back propagation neural networks. That was pretty exciting. But things advanced quite a lot. And in a purely mechanistic way, we see deep learning, not deep learning, but machine learning, for example, decision trees, powering Deep Blue to beat Garry Kasparov at chess. First in 1997, then using natural language processing, IBM Watson was able to win Jeopardy in 2011, and then of course most recently AlphaGo, using deep learning this time, was able to beat the world's Go champion, which is considered a very complex game with a significant amount of uncertainty, and then and also strategy. Deep learning also wins at all Atari video games. In fact, it can self-teach itself, of course, to play and win, get the highest point score very quickly. Then most recently, Libratus, an algorithm developed out of Carnegie Mellon by a professor there, is winning at Texas Hold'em Poker. That was earlier this year in January. And interesting about that article, there was an article on this, and there was an interesting quote here. It's able to deal with imperfect or hidden information. So in Texas Hold'em, obviously, there's a lot of bluffing. There's a lot of cards that are unknown, your opponents. Secondly, there are strategic insights that are coming out of machine learning algorithms like Libratus. So what's interesting here is you can even see how a better way for humans to make decisions and where humans are biased. So in this case with Libratus, it was very aggressive, making huge bets to win small prize pots. Now that's, for most humans, they would think that's ridiculous. Why would I want to make a big bet just to take the ante in the game, for example? But in this case, it turns out to be a good strategy, precisely perhaps because so many humans don't want to play that way. So it's these hidden advantages, this hidden edge that the machine learning seems to find, and actually by using machine learning algorithms like decision trees where we can pull out what seems to be working well, we can probably also enhance human decision making based on this. So in machine learning in general, there's really an art and a science. By being practitioners of using machine learning, we believe we've got a good sense of the art. But again, we're not PhDs working with this. We haven't developed our own algorithms. Rather, we've been using others and trying to adapt them for financial markets. Some of the challenges that we're facing, though, are things like algorithm selection. And then once we have a number of indicators, there's obviously thousands or even millions of potential indicators to pull into a machine learning algorithm. But to have too many indicators is really to overfit and to introduce noise. So we have to have sensible ways of reducing dimensions. And then feature selection and parameter tweaking are all challenges that I'll get to later. Chief danger in machine learning is overfitting, which is really a chronic disease that's very difficult to eliminate. And to do this, we find that ideally it's not just the machine learning expertise that's needed. You know, a great data scientist can approach financial data, but without knowledge of markets and how markets evolve and regimes and other issues, often will not do so well, will require quite a bit of understanding before they can actually effectively apply these in trading. So here's some common packages and frameworks. Please request this if you'd like to see these, but these are very easily accessible via Google search. For example, Python, R has packages. Every language really has something, but these tend to be the best, Python and R. And then you can use environments like Anaconda or Docker for setting this up. And there are some cloud like Amazon AWS is quite useful for machine learning, but it's very expensive. So some people have turned to Microsoft Azure, but on that platform now it's not supporting Python, which has created a lot of issues for people. And there are even next generation people are looking at quantum computing, like D-Wave Systems is now doing some forays into financial data processing to see how much, by what factor they can speed up complex multi-threaded calculations. So this common algorithms, and the ones that we've used are bolded here, and I'll talk about the results from these, are neural nets, support vector machines, nearest neighbors, random forest, gradient boosting, and then there's a number of toolkits for deep learning that are quite useful as well. And then later, again, I'll show you results from some of these bolded techniques here. So everyone, all of us, have the same access to these algorithms. And most Kaggle, when you look at what works in a Netflix competition or on Kaggle where competitions are posted for solving by machine learning, we see that most people start with XGBoost as their chosen algorithm. The key, though, is not just the algorithm. I mean, everyone has the same access. The key to the winners of Kaggle competitions are how the people involved transform the features and select the features that they'll use. So this is called dimension reduction and feature selection. And this is key. We also can, also the winners in Kaggle competitions tend to derive new or novel features, and they tend to have unique data sets, ones that others aren't using. So if you can find a unique data set and have a real rationale for using it, which is again dependent on domain expertise, then that is really where a lot of the value comes in. And also most people in Kaggle competitions seem to use ensembles. So random forest, ensemble of random trees, for example, can be quite useful. And that's the basis of gradient boosting, which is XGBoost. So again, the art, though, is a little bit different. Dimension reduction and feature selection and tuning the parameters really depends on domain expertise, and then tuning the parameters depends on experience with machine learning, and that's developed over time and through real-world applications. So in the decision tree arena, what we see here is that classification trees, we see some examples here, so you see some visuals. On a weekly basis, for example, in this example classification tree, we would see that in this particular asset, when the sentiment is greater than -0.3, yes, that's 97% of the sample, it tends to go down in the subsequent period, but when it's lower than that, which is 3% of the sample, it tends to go down much more likely. So very low sentiment in this case leads to, seems to predict the price going down, and that's at an extreme value. So classification trees really pick up on these different branches that show us extreme values with high returns, often very narrow situations. And then random forests allow us to reduce overfitting to some extent and help us detect the best variables and inputs and indicators. Both of these seem to have pretty good out-of-sample results in our testing, meaning that if we find, using random forests, if we find optimal trees and then run them forward in an out-of-sample set, the entire batch, on average, will outperform a benchmark. So it's finding some value. The question is how to squeeze the most value out of this and how to reduce volatility. So gradient boosting is another approach, and this really uses ensembles of trees, and they're trained on the previous errors of the other trees. So this way, you're trying to cover every aspect of the, of the problem, really, where it works and also where it doesn't work. The keys to success with this technique are, again, dimension reduction, feature selection, and the hyperparameters. And the hyperparameters are tricky because there's so many to experiment with, like learning rate, number of trees, and the max depth of the trees. It goes on and on in terms of how we can tweak this. A lot of people use a grid search to approach this, and that can be a decent solution. But again, it's all tricky, and it can definitely lead to overfitting. So we recommend testing hygiene to minimize overfitting. There's a lot of different ways to do this. Every modeler has their own preferences. A lot of people use cross-validation, which is, in our experience, very useful. The problem with cross-validation can be if you've got long-term moving averages in your results, it's very difficult to parse those out. If you're sampling from within the data set and using that as an out-of-sample, then you're actually looking back on information that's already included in the training set, and that creates a problem. So holding these out temporally is often the best way to do it, meaning in sequential time. So often we'll take the training set as the first 70% to develop the model, and a dev set, which is the next, say, 15%, to optimize the hyperparameters. So we'll get the best result on the training set that also gets the best result on the development set by optimizing the hyperparameters for both. Then we'll look at an out-of-sample set, maybe 10%, to confirm that this entire style is working, that there's some good results here. And if we're testing, say, the top 10 models we've developed and all of them are performing well, then that probably gives us some idea that there's some good performance to come. Then we have an extra 5% that might be a true out-of-sample set, which is really your reality test. How does this actually work? Now, overfitting is, of course, the key. One rule of thumb to avoiding overfitting is to not use more than one input variable, meaning one indicator or feature for every 50 rows of data. So, for example, if you're doing a daily forecast, you'd have to use 50 days of data to justify using one feature as an input. So if you have, say, 500, then you could use 10 features potentially as an input. And then the parameters that and features need to allow for many degrees of freedom. And fundamentally, if you have an approach that works for one asset, it should also work for many other uncorrelated assets and time windows. Here's an example of overfitting. So in this case, what we have here is a perfect P&L. I think it was calculated the 60 quadrillion were your returns since 2000. So not bad. I think you would control the Earth and the entire universe if you had these kind of returns. But of course, in real life, here's what it did. So we can optimize something. We can use deep learning, for example, to get the perfect fit, and it doesn't work at all in real life. So the question is, how do we prevent this? And that really has to do with allowing a lot of degrees of freedom and accepting that maybe your accuracy is only 60% or maybe your returns are not that great. But the key thing is just to have consistency, this kind of consistency going forward. So here's some academic research that was kind of interesting, showing one example of a CART model. Now, we've got quite a few papers now have accumulated showing the benefits of using machine learning on sentiment data, including ours. So we've got a trove of these papers now showing that, in this case, an excess improvement of returns and arbitrage, say 34 basis points a week, or long-short model, I should say, 30 basis points a week on average. So these are kind of interesting. Question is always, what do we get in the out-of-sample period? And so that's what I'll show you in our trading results here. So we've, again, had 3 experiments. I'll show you 2 of our equity curves going forwards. The first experience was, I did an electrical engineering undergraduate degree at the University of Texas, and I was fortunate enough to have a machine learning kind of leading light allow me to work with neural networks on financial time series data and see if I could come up with financial forecasts. So in 1994 and 1995, I did this in some of my senior classes and as a senior project, and I created some indicators. First, I created a suite of technical indicators, then identified which ones seemed to work the best in the out-of-sample period. Then I ran with those best technical indicators in a backpropagation neural network. 2 things came out of this that were kind of interesting. One is, in fact, I'll skip ahead to that. There it is. 2 things came out of this. One that was interesting was the alpha decay. So you see pretty significant alpha decay over the years to where models would have to be retrained maybe once a year in the late 1980s, and by the time that I was doing this, they had to be retrained every 2 weeks or so to re-optimize. And that was pretty significant decay in the alpha. What was interesting, though, was the ability to actually plot the decay. I mean, in the early 1980s, you could run a model based on technical indicators for years without updating it. But but then it had to be relearned by the mid-1990s every couple of weeks. So clearly other people were using these algorithms and applying them. And this is a perennial problem in finance. If you don't have your niche, you don't have your unique style that others haven't thought of, then you're going to have alpha decay pretty quickly. So you did 4-day predictions, and remarkably, when we started our trading partnership, the first 23 predictions in a row were correct, and this was this is unheard of. How could that be? But naturally, it got to my head. I got excited, started trading more, didn't use stops, and then after a series of 5 or 6 losers in a row, which made sense, it's the mean reversion, suddenly capital was not there as it had been. The profits were mostly gone, and so the partner left, and left me wondering, what did I do wrong? So the real basis for the patterns, though, for my thinking about this was that while I had used price indicators and technical indicators, my own sentiment was really swinging, and there would be days when we'd receive, say, a buy signal, and I would think, no way, I can't buy today. This is a terrible day to buy. Maria Bartiromo on CNBC tells me it's a terrible day. Why would I buy today? And then sure enough, that would be the perfect day to buy. And so we saw many, many days like this, and I actually started documenting it over a couple of years. And it turns out that the media sentiment really did seem to be, when combined with these signals, did seem to be contrary to what would happen next. So when I got a buy signal and the media sentiment was negative, it meant my signal was probably correct. The rest of the time, the signals, if they didn't have a strong sentiment component, were probably random. So I became very interested in sentiment. And in the early 2000s, we started mining text data from stock message boards, news, SEC filings, earnings conference call transcripts, and other areas. We ran a paper portfolio from 2006 to 2008, which did quite well, and then we raised capital based on the success, and we started a hedge fund called the MarketPsych Long Short Fund. So that launched on September 2nd, 2008, right on the edge of the financial crisis, the really bad part of it. And then we ran that through the end of 2010. For that algorithm, we used association rules, which are essentially 4-layer decision trees. And I'll explain that a bit in the next slides. So to develop a model based on decision trees, the reason we started doing this was we started noticing that these little edge cases were quite interesting. So for example, if we had bad accounting, what this means, this is sort of an internal code, what this means is that there was bad accounting news that increased in the last quarter's earnings conference call versus the last 4. So a big increase in bad accounting news. Over the next 5 days, we'd see a negative 50 basis point return versus the S&P 500. So the stock would fall versus the S&P from the next day's open. So it's not like we're doing this right at the time of the call. We're waiting until the next day's open when presumably this has been priced in, but there continues to be a drift. So that's what we were picking up. Now the opposite happened with good accounting news. Interestingly and importantly, not all negative sentiment is the same. Bad accounting news caused a negative drift, but anxiety, so people reporting fears or concerns in the conference call, actually caused an increase in the price from the open the following day. So if there's a big burst in fear, people probably overreacted at the open, and then we got a mean reversion, versus if bad accounting news tended to be priced in gradually over the next week. So not all negative sentiment is the same, and here's the difference between the two. Now, when we broke this down and we looked at these edge cases, we say, okay, so for the last, say, 100,000 earnings conference calls, we see that this rule is true for maybe 426. So not very many, and that's not really enough to run a portfolio on. But there were a lot of these rules, and really single edge cases like this. And we wondered, well, why don't we do some data mining with decision trees and pull out the rules that seem to be the best? So we did that. It turned out that earnings conference calls aren't the best for this because they only occur once every quarter, and we can't really get enough data to have reliable data mining results. So we turned towards the media, news and social media specifically. Actually, specifically social media in this case, because we had a lot of stock message board data. And in this case, we looked for regime-specific rules. That is, when the VIX was, say, above 25, we'd have a certain set of rules, which are generally buy on fear type rules. And then we'd have low volatility rules, which were generally momentum-based rules. If there's good news, the stock will keep going for the next week. That's the type of rule that seemed to come out from the low volatility regime. We also did a human sanity check on these rules because we had some rules just didn't make any sense intuitively, and if they didn't make any sense, we would exclude them, then we would test that, and we found that the human sanity checker also improved the results. So we had quite a few layers of testing and checking. And an example here is what this rule means is going short when the total keywords, these are emotion and thematic words and concepts that are quite significant. When the total thematic content was over 100, so that means people are talking about the stock. Big surge in liking the stock, big surge in people saying it's perfect and there's a lot of perfection in what they're doing, and a big increase in the price, that meant we should go short because it's probably a short-term blow off top and it's going to mean revert down. Then on the other hand, pulling out these decision rules, we would see things like high total keywords, so a lot of content, but people think it's really not perfect, imperfect, bad, and but there's good accounting news, and the price has been down, then it's actually likely to go back up because it has good accounting. It just has a lack of enthusiasm and downward price movement. So these things tended to bounce. And this is an example more of a low volatility regime type of rule. So here's an example of a trade using these from back in 2009. During the swine flu epidemic, there was a lot of fear about leisure and airline and travel stocks because people weren't going to travel because of the swine flu public health emergency. So we see over the weekend this was announced, the stock drops. This is American Airlines stock. We ended up buying it around here based on the spike in fear, and then the little sell-off there, meaning that the fear was starting to abate. And then, of course, it goes up, and we sell it. And, of course, I'm showing you the perfect one, but I'll show you the overall track record here, which is the track record of the hedge fund. So this is the, let's see, I think this is the actual net of fees return. So it had a great, spectacular first 12 months. It was up, hugely. And then it just started to fade as the green shoots of the recovery came in around, June and July. Actually, we had some technical issues here. And then around August or so, it wasn't hitting things right. And then we started trying some other strategies, and those weren't working out too well. It finally did seem to start recovering here, but we were trading so small that it was too late. Didn't matter. So this is the result of a decision tree-based strategy on social media data. Again, it did, it was in the top 1% of hedge funds at first, and then it faded away. And interestingly, so after that, we stopped the live trading here, and we had some really unfortunate technical issues. We were online for this big drop here, and offline for the run-up because of technical issues again, and then online during some downturns and offline during the gains. So we ended up losing when it should have been winning. Then, interestingly, we stopped trading, but the strategy itself, when we ran those rules forward just to test, they had a lot of volatility, but there seemed to be something to them, at least for the next couple of years, or next year, and they became very volatile. So this was not something you can run a hedge fund on because of the volatility. It looked good initially, but then it started to fade. And then you can even see this. It looks interesting. There's definitely something there, but it's too volatile. So more recently, we turned our attention to our data business and really grew out our data with Thomson Reuters. Have been working on that. But last year, someone who'd been working on our natural language processing approached us and said, I developed a really good strategy. Let's run this live. So we launched a live account with this and ended up trading a couple other people's money as well. And this was based on gradient boosting and predicted daily S&P 500 returns. And that was it, just the S&P 500. We didn't get too fancy. We'd been really fancy before. Our other portfolio was a market neutral U.S. equities based on social media. And that in itself was quite mind-numbing because we spent a lot of time working on our hedges and other issues. In fact, we lost, as you would expect, we lost a lot of money to the hedge because the signals were doing well. But in any case, on this most recent one, what we did was transform the data, as I described, analyzed it using our gradient boosting models, and then created a daily prediction, long or short, the S&P at the open, very simple. Started trading it on February 22nd of last year. In fact, we've been used 2015 as the out sample. It did well. And then the true out sample was December, January, into mid-February, and it also continued to do well. It was up like 8%. So then we started trading it with 1 times leverage, and it did well. So then we increased the leverage to 2 times. And then it got, as you can see, it got kind of crazy in terms of the volatility. This is not complete, though. This is through the end of November. Two very interesting things happened here. One is we had good returns around Brexit. In fact, it only missed one day around the Brexit period, in the 2 weeks around Brexit. And again, around the U.S. election. It only missed one day in the 2 weeks around the U.S. election, which is kind of remarkable. Maybe actually 2 days. But it was pretty remarkable how it did during those periods. In fact, the day that Donald Trump was elected, it was long the day before, short the open of the election day. And my partner said, does that mean Donald Trump's getting elected? I said, maybe. Actually, I said, no, don't worry, no way. But of course he did get elected. And so markets tanked. And then at the open, it was short, so we covered it, and then it went long at the open the next day. So we went long, and sure enough, it caught the recovery. So it was pretty interesting. Around these human-driven events, it did well, but the rest of the time, I don't know what's going on. So things started to really malfunction. Unfortunately, we got our trading license for other people around late August, and actually got the new money into the accounts literally at this peak. And it was just a tragedy. We got people in, and then it collapsed. So we got people out. They lost a lot, weren't happy, of course. Then we went offline. We traded a little bit longer ourselves, and then we just went offline. We said something's really wrong here. Started with a new model. It immediately tanked, but recovered, and then it tanked again. So this is from the end of November, and then going into December, it tanked again. And human nature being what it is, unfortunately, so a lot of our investors got in at the top, decreased their leverage down at the bottom, and then increased their leverage again at the top here, and then lost more money again. So that was a sad ride for a lot of people. And then it just kind of went sideways, and we realized now, we turned it off actually because we realized it doesn't know what it's doing anymore. So we're looking at some other options, exploring some other options. So this is, if you'd asked me 2 months ago, I would have said, yeah, machine learning, if you asked me here, I would have said, oh yeah, this is great, machine learning works great, especially gradient boosting. But now that we've done a lot more exploring with the algorithms and looking at things, trying to create some more robust models, it's really hard again. So even though we have all this 20 plus years of experience, it is hard to do this. It is hard to get a good model. I mean, in this case, what's remarkable here is not only was December and January positive, and February was positive, but every month was positive until October. And what a bad month it was. And then November was really positive, up 6%, and then December was down 9.7%. So it was just, that was it. And January was up 1.3, and then February, I'm not sure, it was down a little bit so far, and that's when we shut it down. So our future directions in trying to work through this problem is, number one, trying to understand sentiment, because sentiment, obviously, it's non-linear data here. And when we think that the Trump-related sentiment had a lot to do with the backfiring of our models. What we see is that social media actually is very pro-Trump, and news media was very anti-Trump. And the correlations with fear and anger and all these other indexes suddenly inverted. So if you look at any of the correlations day-to-day on the S&P 500 for fear and anger, they completely inverted in October around the time of the debates, as there was a lot of debating in social media, and it was very difficult to pull that out from just pure stock mentions, which is something we try to do. But it's very difficult to pull that out. And also, we don't retroactively change our dictionaries, so it wasn't something that we could easily do in good faith. Then we also looked at, for example, the Trump sentiment swings now, and it appears to be, for example, Trump's executive orders now that he's president create a lot of angst in the news media. Social media could care less, and they're all excited about stocks going up. So we've got this interesting divergence between the two, news and social media, and a lot of our future directions are going to be focused on that, and also on self-adaptive models that can adapt to changes like this Trump whirlwind that has come into the markets and sentiment, and also creating more diversified models. So if we have one on gold, oil, fixed income, and S&P, that's probably going to be more diversified. It's more of a portfolio approach. So the key, though, if you are out there trying to raise assets with these models, is live returns. Everyone can overfit anything. The key is what can you show in terms of your equity curves. And as you can see, we've technically generated value over time. I mean, we had net of fees, we had a more than 12% return in this model over the last 12 months. I guess this is significantly more than 12%. So, the returns are there. It's possible with these models, but there's a lot of volatility, and investors often can't ride it out. So it's a challenge. But if you can get a low volatility, consistent return, then you're talking. So that's our experience, and those are some of our insights into this actually applying machine learning to financial markets. We're not, we're not the world-class experts on the algorithms, but we certainly are some of the few people who've used this in live trading and are willing to talk about it. So I'd love to hear any questions you have and any thoughts, and we look forward to it. I also have CJ Liu on the line, who's the developer of some of our more recent efforts, and so he's happy to answer questions as well. And actually, to give full credit to Red Buffer, Tayyib Tariq, and Asad Umar, they developed the gradient boosting models that we used in our most recent attempts, or recent efforts, or I should say our most recent trading activities. And they're with Red Buffer out of Pakistan. They do data science consulting, and also NLP consulting that we worked with them on. But yeah, love to hear your questions. We do have one book on trading on sentiment that describes a lot of the features that we use in our models, how to condition sentiment data, how to understand this data. So if you are working with sentiment data and you want to become a domain expert, this is really, I think, the gold standard book, in addition to the book by Mitra, which is called the Handbook of Sentiment Analysis. So this book and that book, I believe, are the sort of the gold standards right now for sentiment analysis, academic research, and practical applications. So love to hear your questions if we have any. Let me see what we have here. Feel free to chat them. Great. Okay. Well, I don't see any questions, so hopefully I've answered them in advance. I wish you the best of luck in your endeavors, and get in touch if you're interested in checking out some of our sentiment data or the book. Happy to talk about the work we do. And I wish you the best. Good luck. Bye-bye.